Welcome to Iron Financial, the place where we forge stronger portfolios by cutting right through all the market weakness. Today, we are putting Dynatrace on the anvil. We're not just looking at it, we are conducting a full structural teardown post-earnings. I'm your lead analyst.
And I'm your market skeptic. Now look, Dynatrace just popped a massive 13% overnight. And of course, the headlines, they're glowing, right? Polished to a mirror shine. But our job here is to take a ball-peen hammer to that finish. We've got to see if this company's structure is built on solid steel rebar or is it just some pretty facade? You know, some drywall and plaster waiting to crumble under the first real pressure test?
That is exactly right. We are not here to echo the company's press releases. We are here to drill down past all the noise, to look at the architectural blueprints of the business itself, and to figure out once and for all if this company is built on bedrock or on sand. Let's get to work and start the teardown. So here is our plan of attack for today. We're going to start with that headline-grabbing pop and ask the tough question. Is it sustainable or is it just hype? Then I'm going to build the financial foundation, brick by heavy brick, laying out the core bull case. After that, I'm handing the sledgehammer over to our skeptic to see if he can find any cracks in my work. Then we're going to examine management's powerful, and I mean powerful, billion-dollar countermove. And we'll end, as we always do, with the final iron financial verdict. Okay, let's dive right into this big jump because this is what everyone is talking about. A stock just doesn't gap up from a close of $33.71 to open over $38 without a massive catalyst. That kind of move, especially on heavy volume, it gets everyone's attention, from the Robinhood day traders to the biggest institutions on the street. But let me be perfectly clear. These big, emotional, knee-jerk moves, they are often traps. It is the financial equivalent of a siren song luring unwary investors onto the jagged rocks of a classic bull trap. So the crucial question for every single investor watching this move is brutally, brutally simple. Are you looking at a solid, reinforced concrete launchpad for future gains, or is this a dead cat bounce that's setting a very elaborate and painful trap? This is the moment where discipline truly matters. You know, chasing a move like this without understanding what's underneath the shiny exterior, well, that's not investing. Let's be honest, that is pure, unadulterated gambling with your hard-earned capital. And that's precisely why we have to ignore the price action for a minute. Just forget the 13%, it's noise. To answer that fundamental question, launchpad or trap, we have to look at the foundation. We have to examine the raw materials of the business. So let's get to the numbers. Okay, now this is where the real work begins. Forget the ticker symbol, forget the overnight gap up, forget the talking heads on TV. Right now, we are looking for structural integrity in the financials. We are popping the hood to take a hard look at the engine that drives this entire business. We need to know, is it a high-performance machine firing cleanly on all cylinders, or is it sputtering and backfiring, just waiting to stall out? All right, first pillar, the top-line revenue, $515 million for a single quarter. Let's be very clear about this. This is a solid, heavy-duty number. This isn't some speculative startup with a dream and a PowerPoint deck. This is a scaled enterprise that is generating significant, consistent sales, and it's doing it in what we all know is a tough macroeconomic environment. This right here is the first load-bearing wall of the bull case, and believe me, it's built thick with high-quality enterprise-grade contract. Now for the second pillar, profitability. 44 cents per share on a non-GAAP basis. This is absolutely critical. In today's market, the whole growth at any cost model from a few years ago, that's dead. It's a relic. The market demands profit. Investors want to see that you can not only grow your sales, but that you can actually turn that growth into tangible, real profit for your shareholders. This figure right here, it shows operational discipline. It tells you that the company is a well-oiled machine generating real cash, not just burning it to chase revenue numbers. And this is the bedrock. Annual recurring revenue, just a stone's throw away from $2 billion. For a software as a service company like this, ARR is the holy grail. It really is. This is the predictable, contract-based revenue that provides stability and, crucially, visibility into the future. It's not about volatile one-time sales. It's the solid foundation upon which everything else is built. Nearly $2 billion of it tells you this company has a massive, entrenched, and very sticky customer base that is locked into its ecosystem. That is a formidable competitive moat right there. Now, what's really fascinating about this slide is the context it provides. It's not just that the numbers are big and impressive on their own, it's that they delivered a complete beatdown on expectations. I mean, just look at this. They beat on revenue, they beat on earnings per share, and they beat on that all-important ARR metric. This isn't a company that's just hitting its targets. This is a company that is consistently exceeding them. They told Wall Street they'd do one thing, and they went out and did better.
That signals strong execution and it builds a ton of management credibility.
And this chart just brilliantly illustrates the momentum they have. An 18.2% year-over-year revenue increase at this scale is not a trivial accomplishment. We're talking about adding almost $80 million in new revenue compared to the exact same quarter last year. This is the heavy lifting that supports a higher valuation. The structure is getting stronger, quarter after quarter. This isn't a static business, it's a dynamic, powerful growth engine. All right, analyst, all right. You've laid a very clean, a very strong foundation. The numbers look polished. I will absolutely give you that. But you know, a polished concrete floor can hide some very deep, very dangerous cracks. A fresh coat of paint can cover up all sorts of rot underneath. So let's see how this pristine structure of yours holds up under a real, proper stress test. So I've got my hammer out, and I see a few spots that look, well, they look weak to me. Strong numbers are one thing, but they only tell you about the past. They're a lagging indicator. Things like market action, insider behavior, and the competitive landscape, these things tell you about the future. And right now, believe me, they are telling a very different and a much more cautious story than those headline numbers. This is the question. This is the one that separates disciplined investors from the hype chasers who inevitably get burned. What is buried in the fine print? What's the context that's conveniently missing from the headline numbers and the press release? You have to ask yourself, if everything is so perfect, then why are there so many warning signs flashing just beneath the surface? This is where we need to grab a shovel and dig a whole lot deeper.
So let's break it down. First, the people who know the company best, the insiders walking the halls every single day. They are selling their stock. Second, the so-called experts on Wall Street, well, they're speaking out of both sides of their mouths. They're telling you to buy the stock while simultaneously lowering their price targets. That is a massive contradiction that just screams a lack of real conviction. And third, before this big earnings pop, the chart itself was telling a story of major technical weakness. It was trading below its 50-day and 200-day moving averages. Those are key long-term trend indicators. In simple terms, the market was already voting with its feet, signaling that something was wrong before these earnings ever came out.
And just look at this data. This isn't just a bit of pocket change for a vacation. The chief executive officer, the captain of the ship, sold over 21% of his entire holding in the company. He cashed out nearly $1.4 million worth of stock. The chief accounting officer also sold a meaningful chunk. I mean, when you see management cashing out over $1.8 million in stock in a single quarter, it has to force you to ask a very uncomfortable question. What do they see that we don't? Are they selling into what they perceive as strength? It's a huge red flag. Now, on the surface, this chart looks fantastic, right? 18 different analysts are screaming buy. The consensus rating is a moderate buy. This is the slide the bulls and the company's own investor relations department will wave right in your face. It looks like a strong, unified vote of confidence from the entire professional analyst community. But this is only half the story. And here is the crack in that armor. This is the detail that truly matters. Truist, Jefferies, Rosenblatt, Scotiabank, Royal Bank of Canada, all of them cut their price targets right after their earnings report. Now, just think about what that means for a second. It is like a car mechanic telling you your engine is in absolutely great shape, but then he tells you he's lowering its top speed rating. It just doesn't add up. It signals a deep, deep lack of conviction. They're effectively saying, yeah, we think you should buy it, but we also think it's worth less than we did yesterday. That is a hedge, plain and simple, and it tells me they're worried about something down the road. Those are very fair points, Skeptic. The insider selling and the analyst price target cuts, that's undeniable data. It absolutely has to be considered. But you're missing the single biggest sign of conviction from management. You're missing an action that speaks far, far louder than the personal stock sales of a few executives. You see those insider sales as a structural weakness, and I get it. But I see them as potentially prudent personal financial planning. We don't know their individual circumstances. So let's look at what the company, as a single entity, is doing with its corporate treasury. That is the real, unambiguous signal of confidence. That's where conviction is literally forged in steel. $1 billion. Just let that number sink in for a second. This is not some small token buyback program designed to placate a few noisy shareholders. This is a massive, overwhelming authorization to go into the open market and buy their own stock. This is management, backed by the board of directors, stating in the loudest, most financially significant terms possible that they believe their stock is fundamentally undervalued. A $1 billion buyback is a tidal wave of conviction that absolutely drowns out the noise of a $1.8 million insider sale. It's not even in the same league. And get this, They are backing up that billion-dollar bet with improved performance. They didn't just beat the estimates for the third quarter, they raised the forecast for the entire year. Let me tell you, you do not raise guidance if you see weakness ahead. You don't raise guidance if you're worried about competition eating your lunch. You raise guidance when your foundation is solid steel and you are building for a much stronger future. They are telling the market unequivocally that the engine is running better and faster than even they expected. And right here, this is the long-term structural thesis. This is the why. This is the reason they have the confidence to raise guidance and authorize $1 billion buyback. The CEO is positioning Dynatrace not just as another monitoring tool, but as the essential, indispensable control plane for the entire AI revolution. Think about it. As AI gets deployed everywhere and becomes exponentially more complex, the need to observe, manage, and secure it becomes completely non-negotiable. It's mission critical. That isn't a cyclical trend. That is a massive structural tailwind that could propel this company for the next decade. A big buyback and a good story. I will absolutely grant you that. That's a very strong counterargument, but it doesn't just erase the risks entirely. No way. It just puts them in balance. So the time has come. Let's put everything on the scales and weigh all the evidence we have. All right, this is what it all comes down to. We've inspected the foundation, we've stress tested the walls, we've seen the strengths, and we've definitely seen the cracks. It is time for the final Iron Financial verdict. Okay, the opportunity is crystal clear, and it's built on a steel frame. You have a fundamentally strong company with accelerating profitable growth. It consistently beats expectations, it's tied directly to the AI megatrend, and you have management backing it all up with $1 billion buyback and raised guidance for the future. The foundation is solid, and the trap is just as clear. The people on the inside, the ones who know the most, are selling. The analysts on the outside are hedging their bets and talking out of both sides of their mouths. And before this pop, the market itself was deeply skeptical, pushing the stock into a clear downtrend. There are external pressures and real competitive threats that could crack even a strong foundation. This is not a risk-free proposition by any stretch of the imagination. So the crucial point we're left with is this. Dynatrace has forged a powerful, verifiably strong financial foundation. The numbers, the growth, the profitability, they are undeniable facts. The question, therefore, is no longer about the fundamental quality of the company itself. We've established that the structure is sound. That part of the work is done. The real question, the one you have to ask yourself, is about the environment and, more importantly, about your own personal conviction. Are you willing to build on that strong foundation when the ground around it is shaky? Do you trust the company's billion-dollar capital allocation signal more than the executive's personal stock sales? Ultimately, that is a decision only you can make. So do your own diligence. We've given you the blueprints, and we've pointed out all the stress points. Now it's up to you to decide whether to start building. Thanks for joining us here at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.